Thanks for joining us for the executive series. Today I'm talking to Peter Switzer, who is the chairman of the Switzer Asset Management Group, who have just launched the Switzer Dividend Growth Fund. Peter, it's good to be talking to you, actually. It's a reunification of sorts.
That's right. It's interesting that you're asking the questions this time. And I'm giving the
who would
answers.
have thought?
Yeah.
Who would have thought? But an exciting time for the group because you've, as I said, just launched the Dividend Growth Fund. But why don't we just quickly reflect on your thoughts on what's going on in the markets. You've got a wealth of experience in terms of putting things into context, and we're at a pretty interesting fork in the road, if you like.
Yeah, I think so, Tom. I think the old saying that a stock market is scary in the short term but reliable in the long term, I think that's probably applies now. I'm a little bit nervous about what might go on. We've had a fantastic run-up since Trump has become president. The momentum was already there. The economic fundamentals were still pretty good even before he was elected. I think he's turbocharged the global economic outlook. It certainly has helped charge the equity markets. And so a lot of companies are very well priced. And so when people actually ask me, what companies do you like right now, it's hard to identify them because you know they've been for a nice run. But I do believe that we're poised for a good year. So 2017 will be a good year, but there just could be a bit of volatility along the way.
Okay, so you're not concerned about President Trump having promised the world and potentially delivering an atlas?
No, I'm concerned that maybe it won't deliver as quickly as we thought. We all hope that health reform within the first 100 days and tax reform maybe by mid-year. At the moment they're hosing that down, people like Peter Ryan, the House Speaker and the tax man for Trump, they're hosing it down. I think they'll do it. I think some tax reform will come. And from my point of view, if it came too quickly, Tom, it would worry me that the market would have spurted too high, too quickly. And that might have really left us open to a big sell-off. A bit of a pullback now wouldn't be a bad thing, I think, for the market.
Okay, well, let's focus on the Switzer Dividend Growth Fund.
Yeah.
Obviously, in a low interest rate environment, that has been an important motivation for establishing this sort of investment vehicle.
Yeah, and look, people have always asked me, how do you invest? And that's part of the reason why we created this, because we are a financial planning business as well, but a lot of people just don't want to do a financial plan. They want to invest the way I invest. And I've always been a supersonically cautious investor, and I always love quality companies that pay dividends. But a lot of people can find the top 4 banks in Telstra, but they can't find a lot of other companies out there. The great companies, a lot of the experts who come on my TV show talk about it all the time. They're the kind of companies we wanted to include in this dividend growth fund. Companies that not only pay dividends, but grow their dividends. And if you get a company like that, invariably their share price goes up, so you get capital gains. So we're trying to pull off the double play, but chasing top quality companies all the time.
Okay, so obviously in describing the features of the fund, you'd highlight organisations that have got durability in terms of their dividend payments.
Yeah, without a doubt. And we're putting together, we're looking at the best companies basically in the top 200 that have this history of paying dividends. But the features I think a lot of people like also are the fact that that the fee is really low compared to managed funds, 0.89%. We've also got dividends are being paid quarterly. And there aren't many funds do that. Most fund managers have been trained to pay halfly or even annually. And so we think a lot of our investors who would like our kind of product, they want to see the income paid back to them, and we're going to do it on a quarterly basis.
Okay, so you mentioned the sort of investors that you're targeting. Who are they?
Well, I think the classic people who like our type of fund are the self-managed super fund retirees. It forms, I think, a core of a really reliable portfolio of shares. A lot of retirees don't want, or future retirees don't want a group of shares that go up and down and are volatile and don't pay dividends. I figure that even when the market goes down, this fund will keep on paying really good quality dividends, and people will then can ride out the tough times and then benefit in the good times. I think there's a lot of young people, young as you, Tom, who actually still like reliable stocks that don't go up and down all the time and keep paying dividends. So I think there are people out there like that.
But I'm going to use a non-digital term and say that you've got a great Rolodex in terms of market contacts. So who have you recruited to steer the fund?
Yeah, okay. So obviously we want great people on the investment committee, and we've got Paul Rickard, who of course was the founding CEO of CommSec. George Baburis is the CEO of Contango Asset Management, and they're a very good fund manager. And of course, Charlie Aitken of Aitken Investment Management. And Charlie's renowned for his understanding of the markets and sort of stuff. So putting us all together in the investment committee, you've got a group of people who've got strong ideas. They're quite happy to criticise each other if need be. And the end result, I think, will be a great collection of companies that will really be the right kind of companies for the self-directed investor we're talking about.
Indeed. So step us through some of the key aspects of the strategy that you put together.
Okay, so the strategy basically is there'll be about 30 to 50 companies. They'll have this history of paying good dividends. They'll be the kind of companies that do well over time, and they will have, I think, a pretty good resistance to gravity when markets become a little bit scary.
And Peter, what are some of the leading names that you're going to be using to establish a platform for the fund?
Obviously, the blue chippers are going to be there, the banks and Telstras and those sorts of companies will form the core. But what we think is our competitive advantage is that the people who are managing the funds, they know the companies, they have a great history of paying dividends, but also can grow the dividends. So they'll know when it's the right time to buy companies like QBE and Amcor and add them into the overall mix, blending, in a sense, the dividends, so that in the end result will be that we'll produce results, I think, that will be better than the typical kind of dividend type fund out there.
Peter, it's been good talking to you again. Thanks for your time.
Cheers, mate.
And thanks for joining us for the Executive Series.